The difference between a savings account and a checking account isn't just semantics. It's the difference between money that works at the basic level for you and money that sits there doing nothing. If you don't understand the strategic purpose of each account type, you're playing the money game with one hand tied behind your back. Today, we're going to break down exactly what checking accounts and savings accounts actually do, why they exist, and most importantly, how to use them strategically to maximize your money. Because when you understand the tools, you can finally build something. This is MindSnack Finance, bite-sized lessons with lasting value. Let's start with the account everyone has but few people truly understand, the checking account. A checking account is designed for frequent transactions. That's its entire purpose. It's not designed to make you money. It's not designed to build wealth. It's designed to move money efficiently. Think of it as the financial equivalent of a highway. Money flows in, money flows out, constantly. This is where your paycheck lands. This is where you pay your bills. This is the account connected to your debit card, your checks, your Venmo, your Zelle, your autopay subscriptions. It's your operational account, your daily driver, your financial command center. Checking accounts typically come with a debit card, checks, and online banking features. Some come with mobile apps, Zelle integration, bill pay services, and instant transfers. The point is accessibility. You need to access this money quickly, frequently, and without barriers. And here's the trade-off. Checking accounts usually have no interest rate, or if they do, it's laughably low, something like 0.01% annual percentage yield. You're not putting money in a checking account to grow it, you're putting it there to use it right away. This is important to understand because a lot of people treat their checking account like a savings account. They keep thousands of dollars sitting there just in case, thinking they're being smart by having liquid cash available. But that cash isn't growing, it's actually shrinking relative to inflation. Every year, that money buys less than it did the year before. A checking account is meant for everyday spending and managing your daily finances. The general rule of thumb? Keep 1 month of expenses in your checking account, enough to cover your bills, your spending, your buffer for unexpected costs. Anything beyond that shouldn't be sitting idle in checking. It should be working for you elsewhere. But here's where people mess up. They confuse liquidity with accessibility. Yes, you need liquid funds for emergencies and daily life. But liquid doesn't mean it has to sit in a checking account earning nothing. That's where savings accounts come in. Now let's talk about the traditional savings account, the one most people opened when they were 12 years old at a local bank branch. A savings account is intended for keeping money for longer periods, often for specific goals or emergencies. This isn't your daily spending fund. This is money you're setting aside with intention. Money you don't plan to touch unless necessary. Money that's designated for something beyond today's lunch or this month's rent. Here's the key difference. Savings accounts typically earn interest on deposited funds. Now, let's be honest, traditional savings accounts at big banks earn almost nothing. We're talking 0.1% to 0.05% annual percentage yield in most cases. At that rate, if you have $10,000 saved, you're earning maybe $1 to $5 per year. Before taxes, it's basically nothing. But it's still technically more than checking. And the psychological separation matters. When money is in savings, you're less likely to spend it impulsively. There's a mental barrier, even if it's just the friction of transferring funds between accounts. Traditional savings accounts also may have restrictions on withdrawals or transfers. Federal Regulation D used to limit savings withdrawals to 6 per month, though many banks relaxed this during the pandemic. Still, the point remains. Savings accounts aren't designed for frequent access. They're designed for accumulation. The purpose of a basic savings account is simple: to help grow your savings while keeping them liquid. You can access the money when you need it, unlike investments or CDs where there are penalties or waiting periods. But there's just enough separation to discourage you from spending it on impulse. The problem? In today's financial landscape, traditional savings accounts are obsolete for serious savers. They're a relic of a time when 0.1% interest was acceptable. It's not anymore, because there's a better option that many people still don't think about. Here's where things get interesting. Enter the High Yield Savings Account, or HYSA for short. Think of it as the upgraded performance version of a traditional savings account. Same basic function, holding your money safely while earning interest, but with one massive difference. High-yield savings accounts tend to pay a significantly higher interest rate, sometimes similar to the inflation rate. We're talking about rates that are currently in the 3.5% to 4% annual percentage yield range, compared to the 0.01% you'd get at a traditional bank. That's not a small difference. That's a 350x to 400x difference. On $10,000, that's the difference between earning $1 per year and earning $350 to $400 per year. That's real money. This account is designed for savers who want to earn a higher return on their money while maintaining easy access to their funds. That last part is crucial. This isn't an investment. You're not taking on risk. Your money is still FDIC insured up to $250,000. You can still access it whenever you need it, usually the same day or within one business day. But while it's sitting there, it's actually growing at a rate that keeps pace with or beats inflation. So why doesn't everyone use these? Two reasons. First, many people don't know they exist. Traditional banks don't advertise much because they'd rather pay you nothing and use your deposits to fund their loans. Second, high-yield savings accounts are typically offered by online banks, institutions without physical branches. And some people still don't trust what they can't walk into. But here's the reality. Online banks have lower overhead costs, no expensive branch networks to maintain, and they pass those savings on to customers in the form of higher interest rates. They're not sketchy, they're efficient. And if you're serious about making your money work for you, you need to get comfortable with them. If you plan to save money for the short to medium term, use a high-yield savings account. This is ideal for emergency funds, the 3 to 6 months of expenses you keep for job loss, medical issues, or unexpected crises. Saving for a vacation. That trip to Hawaii you're planning for next year. A car purchase, accumulating the down payment, or saving to buy outright. A wedding, building the fund for what's likely one of your biggest life expenses. Home down payment, stacking cash for your first house or investment property. These are all short to medium-term goals, meaning you need the money to be accessible, but you also don't want it losing value to inflation while you save. A high-yield savings account solves that problem perfectly. The money grows at a rate that protects your purchasing power. It's liquid enough to access when you need it, and it's separate enough from your checking account that you won't accidentally spend it. Now, here's where strategy comes in. Because the real power isn't choosing between account types, it's using them together intelligently. Ideally, you should pair a checking account for your day-to-day money transactions with a high-yield savings account to keep money aside. This is the foundation of smart cash management. Two accounts, two distinct purposes, working in harmony. Your checking account handles the operational side of your life. Paychecks come in, bills go out, you swipe your debit card, you transfer to friends, you handle the logistics of living, you keep 1 month of expenses in there as your working capital, your buffer, your operational funds. Everything else, your emergency fund, your goal-specific savings, the money you're setting aside for future you, goes into your high-yield savings account. That money earns 3.5% to 4% interest instead of nothing. It grows while you're not looking at it. And because it's in a separate account, often at a different bank, you're less tempted to touch it. This separation creates what behavioral economists call mental accounting, but in a good way. The checking account is spending money. The savings account is future money. Your brain treats them differently, which helps you stick to your financial plan without requiring constant willpower. But here's the key that makes this system bulletproof. Automate transfers from your checking to your savings account to keep a steady savings rate. Automation removes decision-making from the equation. You're not relying on discipline or remembering to transfer money at the end of the month. You're setting up a system once, and then the system does the work for you. Here's how it works in practice. Your paycheck hits your checking account on the 1st and 15th of the month. On the 2nd and 16th, an automatic transfer moves a predetermined amount, let's say 5% to 10% of your income, from checking to your high-yield savings account. You never see it, you never touch it. It just happens. This is the pay yourself first principle, automated. Before you can spend the money, before you can rationalize keeping it in checking just in case, before your brain can come up with creative reasons why this month is different, the money is already gone. Already saved, already earning interest, and the beautiful part? After a few months, you don't even notice. Your brain adjusts to the lower amount in checking. Your lifestyle calibrates to the new normal, and your savings grow on autopilot. This is how people who aren't good at saving suddenly become excellent savers. Not through willpower, through systems. Let's talk about the mistakes people make with these accounts because knowing what not to do is just as important as knowing what to do. Mistake number 1, keeping everything in checking. This is the most common error. People receive their paycheck, pay their bills, and just let the rest sit in checking indefinitely. That money could be earning interest in a high-yield savings account, but instead it's earning nothing. Over years, this costs thousands in lost interest. Mistake number 2, keeping too much in checking. Even people who have savings accounts often keep $5, $10, even $20,000 in checking, just in case. Unless you have massive monthly expenses, you don't need that much operational capital. Move the excess to your high-yield savings account where it actually works for you. Mistake number 3, using the wrong savings account. Having a traditional savings account at a big bank earning 0.01% when high-yield savings accounts exist is leaving money on the table. It takes less than 30 minutes to open an account online. That little time could be worth thousands over the next few years. Mistake number 4, not separating accounts by goal. Some banks allow you to create multiple buckets or sub-accounts within your savings. Use them. One bucket for emergency fund, one for vacation, one for car, one for any other specific needs. This clarity prevents you from raiding your emergency fund to pay for a vacation. Mistake number 5, manual transfers. If you're relying on yourself to remember to move money to savings each month, you're going to fail eventually. Automate it, set it, and forget it. Let the system do the work. Mistake number 6, checking account fees. Many checking accounts have monthly maintenance fees unless you meet certain requirements like direct deposit or minimum balance. Don't pay these fees. There are excellent free checking accounts with no minimums and no fees. Shop around. These mistakes are all avoidable. They're all fixable. But you have to know they exist before you can correct them. So how do you actually choose the right accounts? Here's the criteria. For checking accounts, look for no monthly fees, no minimum balance requirements, easy access to ATMs or ATM fee reimbursement, strong mobile app and online banking features, instant transfers and payment options, good customer service. For high-yield savings accounts, prioritize competitive interest rate, currently 3.5% APY or higher, FDIC insurance, this should be non-negotiable, no monthly fees, no minimum balance to earn the APY, easy transfers to and from external accounts, good customer service. And here's a pro tip. You don't have to have your checking and savings at the same bank. In fact, it's often better to separate them. Checking at a bank with great features and access, high-yield savings accounts at whoever offers the highest rate. The slight inconvenience of transferring between banks is actually a feature, not a bug. It creates just enough friction to prevent impulsive spending from savings. This isn't complicated. It just requires understanding the tools and using them correctly. Stop leaving money on the table. Stop letting your cash earn nothing when it could be earning something. Stop treating all bank accounts like they're the same when they're fundamentally different.